I'm John Kosar from Asbury Research, and this is the Asbury Approach to Investing video for January 2023. You can subscribe to these videos below. Today's date is January 26th. The purpose of these free monthly videos is to introduce professional and private investors to our unique data-driven approach and quantitative models. This video focuses on Asbury Research's unique quantitative models and is actually a small subset of a much larger and more detailed monthly report that we produce for our paid subscribers, among other reports. All Asbury Research reports and models answer two primary questions. Number one, should I be invested and how much? Number two, where should I be invested? Which parts of the market should I be invested in? Okay, let's begin and follow the money. This is a little bit about my background that I won't spend a whole lot of time on, but this is my 42nd year in the financial markets. I started my career as a young 20-year-old down on the floor of the Chicago Mercantile Exchange back in the early 1980s. I spent 17 years there, and that was really my college and my master's degree. I got a chance to be around trading every day and watch and understand really how financial markets work from the inside out. What we do, we basically follow the money. We are very data driven here, and rather than trying to forecast, rather than trying to predict, we are watching data. We're watching data flows. We are watching the money move around the board, so to speak, and try to go where the money goes. What I have found throughout my career is that first the markets move, and then all of the financial media tells you in great detail why the market went there after the bell rings and everyone goes home for the day. It's much more, following data is much more agile, in my view, than trying to make forecasts or predictions based on fundamental or economic expectations, which can really change at the drop of a hat. So what we do is tell our subscribers when it's time to be aggressive in the markets and fully invested. We call that risk on. When it's time to be defensive and protecting your capital, which is risk off. And a lot of our clients are older and wealthier and more risk averse. They understand that the game changes once you get into your 50s. When you're 30 years old, it's basically building your portfolio for the future. It's dollar cost averaging. Every 2 weeks when you get paid, you go buy more stock. Try to be in the right indexes and have a broad swath of the market. Once you get into your 50s, if you make a couple of bad mistakes during periods where the market really goes down hard, like it did in 2008 and like it did last year, it could really change your retirement. It could change how you're able to enjoy your latter years. So we are very interested here in participating in the markets with less risk. And we'll go into that in just a few minutes. We also look at which parts of the market to buy. After we're risk on, what do you buy? So ideally, you can try to position yourself to outperform the market or outperform the S&P 500. So we look at industry groups, we look at some individual stocks, we look at opportunities in the global equity markets. We have a model that tracks that we'll look at in just a few moments. And then we look at a lot of ETFs. We follow the asset flows and a lot of ETFs to tell us where the market is, where the money is going, and where we should be. How we do it. We have 5 data-driven models that we're going to touch on today. Our first one is the Correction Protection Model, or CPM. It was built for wealth preservation. Again, for more risk-averse stock market investors to participate in the market with less risk, significantly less risk. Our Asbury 6 model is our indicator that we update every day that tells us what the real internal condition of the market is, what the internal health of the market is, because you can't do that anymore by watching the S&P 500 and maybe 1 or 2 indicators because the day-to-day volatility is so high. We've all seen it. The market rallies 70 or 80 points one day, forces us in, and then the very next day it takes that away, and we're down 50. We don't want those short-term activities to be driving our emotions, our fear and greed, to be making mistakes in the market. The Asbury 6 keeps us from doing that. Our SEAF model, sector ETF asset flows, that follows the asset flows, follows the money around the 11 sector spiders, which together comprise the S&P 500. Our CART model stands for Cross Asset Relative Performance. That tells us where the outperformance is in bull and bear markets alike. And finally, our U.S. versus the world market tells us where there are opportunities overseas. Last year, in 2022, we had a bear market here in the States. There were a lot of opportunities to take some of that sideline money here and bring it over to other parts of the world and make a return, and we'll take a look at that at the very end. So let's begin with our CPM model. We were asked to build a model, it must have been maybe 12 or 13 years ago, to allow more risk-averse investors, typically older, how to participate in markets with less risk. So we built the CPM model. CPM using SPY stays very close to the S&P 500 in terms of performance with less than half the risk. We'll look at some numbers in a minute. And then we actually back tested using CPM with a leveraged ETF. So you could build back in some of the risk and get significantly better returns. So let's have a look. This is our CPM model. CPM is, again, it's correction protection model. This area on the left here is the yearly performance of CPM trading SPY, which is, of course, the ETF that tracks the S&P 500 versus the S&P 500. You see from 2011 through 2022, it's underperformed the S&P by 2%. So you might say, why is underperformance good? Down at the bottom here, there's a lot of quantitative metrics here. It shows that trading CPM with SPY, it resulted in a beta of 0.44. The beta of the S&P 500 is understood to be 1.0. That's the market. So according to beta, it's less than half the risk. Look at the maximum drawdown here. Maximum drawdown in the S&P is 33.9%. With CPM via SPY, it's only 15. It's less than 0.5%. Look at the risk according to standard deviation. 9% for CPM compared to 14.4% for the S&P 500. So then we said, what happens if we add some of the risk back in by using a leverage ETF? So here we have the same data, but now we're trading the SSO, Susan Oscar, which is a 2 times leveraged SPY. Basically, it's also a spider product. And you can see now this takes our average annual relative performance to plus 5.7. So we're almost outperforming the S&P by 6% a year. And what that does is it brings our beta up to 0.87, still a little less than the S&P at 1.0. It brings our maximum drawdown to 29.5, still a little bit less than the S&P, which is 33.9. Our standard deviation goes up a touch to 17.9 to 14.4. So the purpose of showing you these two is to show you the gist of what the CPM does. And the CPM is extremely good at mitigating risk, lowering the volatility in the portfolio. It does that by moving out of the way when the market goes down and moving back in after the market starts to move up. Last year, CPM, trading it with SPY, it outperformed the S&P by 12%. Our CPM, here's a chart. It's currently risk on is the January the 12th. That's the rightmost green arrow here that I'm circling. And you can see the gyrations. Red is risk off, green is risk on. It caught the big moves of last year. And like this one from April 12th to May 26th, it put us in cash. So we avoided this large drawdown. Our Asbury 6, again, it's an indicator as opposed to a model like CPM. Our Asbury 6 looks at 6 different metrics that we back tested to kind of use as a team of metrics that tell us what the internal health of the market is every day. Similar to when you go into the doctor's office for your annual visit. He sits you on the table and he takes your pulse. He checks your blood pressure. He checks your reflexes, listens to your heart and lungs. There's a couple of more that he does, or at least my doctor does. And after he does that, he has a much better baseline understanding of what your health is, rather than seeing you walk through the door with a nice shirt on and your hair combed. So this is what we use to tell us every day. It's updated 2 or 3 hours after the close every day in our research center. And you can see it actually turned positive on January the 11th, where in the CPM, it was a day later on January 12th. So this tends to be a little bit ahead of the CPM, and it also shows a granular. It shows one by one how these indicators will turn red and then turn green again. These actually started to turn green back on January the 7th or 8th. So we had a several day kind of heads up to watch that the market was starting to strengthen, and there may be some opportunities here coming up in CPM and in some of our other models. Currently, the A6, the Asbury 6, is all green. 4 or more metrics in one direction, either positive green or negative red, indicate a tactical bias for the market. So you can see they're all green, and these numbers in here are the dates that each of these 6 constituent metrics turn green or positive. If 4 or more of them turn red, that's going to tell us the patient, so to speak, is starting to get ill, and we need to look towards maybe playing defense a little bit more, maybe tightening stops, maybe thinking about changing allocations so we can prepare for a move lower. This is another metric that I look at. It's not part of the Asbury 6, but it's really important. This is the S&P 500 up top, going back to August of last year. Excuse me. And down here is the total net assets that are invested in SSO. We talked about SSO as being a 2 times leveraged S&P 500 ETF. Why look at the leveraged one? Because if you're looking at the asset flows in SPY, many investors, a lot of professional investors, will use SPY to hedge a long stock portfolio. So they'll buy the actual stocks and then they'll sell SPY to have a leverage to kind of hedge that long position. So you don't get a real clear reading about who is really bullish, who is really long. This indicator shows conviction in being long. The reason it does is because SSO is 2 times. So it's more of a clear bet, more of a pure bet on being long the S&P 500 than, again, SPY that can be used for hedging purposes. So you can see back on October 20th to December 6th, these assets expanded above their 21-day moving average, which is their tactical time period, and it gave us a 9% rally. It coincided with the 9% rally in the S&P 500. You can see as of Jan the 11th, which is when our Asbury 6 model turned back to green, it's back above the 21-day moving average. These assets are expanding. They're expanding aggressively. That means conviction in the market going higher. There's money coming. There's aggressive money coming into the stock market. That's very important. Let's look at investor sentiment. Again, there's a couple of indicators here that aren't our models, but I think they're important. 2 different gauges here of investor sentiment. This is futures trader sentiment, a variation of Jake Bernstein's DSI indicator, showing that we're at a least bullish extreme that has previously coincided with some pretty important near to intermediate term bottoms going back to 2018. This is the Investors Intelligence data here on the right. It's a little longer term indicator. Asbury Research is actually one of the inputs for the Investors Intelligence data. And look what happened here. It bottomed on October 7th, right before the bottom that we had in the S&P 500. And it's only about halfway to moving up to opposite most bullish extremes. The last 1, 2, 3, 4, 5 times that we had a similar least bullish extreme was in March 2020. That was a COVID low. January 2019, another important low. March 2016, September 2011, and September 2010, all important lows. What does that mean? It means last year we suspected that the June lows were going to be the lows of the year and could be the lows for a couple of years. We made a secondary low in October. It took the June low out by just a small amount for just a few days. We believe that those are intermediate to long-term lows, bottoms in the S&P that could potentially hold for all of this year. So kind of a bigger picture, not with our models, but something else that we do so we can make longer-term projections, have a longer-term understanding of where the market is historically. Here's our CARP models. CARP stands for Cross-Asset Relative Performance. CARP tells us where to be invested. You can see there are 8 different relative performance comparisons here for equities, and there's 3 for fixed income. Currently, high beta is outperforming low volatility. Here, I'm circling it. Broad market, the S&P 500 is outperforming the Dow. That is risk on. That shows risk appetite. Technology is outperforming the S&P 500. That's more risk appetite. Emerging markets are starting to outperform. This is what tells us where to be invested. So when we're in a risk-on environment, we are in the places in the market that are likely to give us some relative outperformance versus the S&P 500. 2 of these, according to the CARP model, EEM, which is the Emerging Markets ETF, our CARP model gave us a signal on November 29th, and it has outperformed the S&P 500 SPY by 8% since then. So this has been a really good one for us while the S&P 500 was transitioning from a bear market to what looks like might be an emerging bull market here. And here's the Qs, which track the NASDAQ 100, which is the big cap index for NASDAQ. This is a new signal. Note that after underperforming since August the 29th of last year, it's now outperforming on a quarterly basis, which is our strategic time frame, since January the 20th. So we're watching the Qs. If the Qs continue to outperform SPY, it indicates risk appetite, and it's overall bullish for the broad market, for the broad U.S. stock market. Here's our U.S. versus the world model. This measures the relative performance of the S&P 500 versus 25 global markets. 21 of these 25 right now are outperforming the S&P 500 on a tactical, which is monthly, and a strategic, which is quarterly basis. That means that the rest of the world, global equity investors, believe that the U.S. is going to keep underperforming, and I think bigger picture, it suggests that they believe that the S&P 500 is still in an uncompleted major downtrend that started a year ago. If they are wrong, the S&P starts to make a bullish trend change, which it appears to be in the process of doing right now. You're going to see this board change very, very quickly, and it's going to move from being overweight these foreign markets to being overweight the S&P 500. The value of this is when the S&P 500 is in a bear market. It wasn't a bear market all of last year. Here's a couple of the signals from the U.S. versus the world, the more recent ones. In September 14th, Italy gave us a signal. Actually, Western Europe, September, October, November area, September, October primarily, started outperforming. It was kind of central to that part of the world. Italy, since our signal, has outperformed the S&P 500 by 22%. In a bear market, again, to take some of your money out of the U.S. and allocate elsewhere is a smart idea, and this is what this model helps to do. It's atypical for these foreign markets to outperform the S&P 500, but they were doing it all of last year. Here's France, another Western European country since October the 10th, which is when our signal came about. In our model, it's outperformed SPY by 21%. Now our CEF model. CEF is unique because rather than tracking relative performance, it tracks the assets that are rotating around the 11 sector spiders. We actually built this model 5 or 6 years ago, and it tends to be much more agile. Over the years, sector rotation has really sped up. The outperformance trends are shorter, and you need to be more agile if you're going to capture them. They're smaller, they're not as big as they used to be, with few exceptions, and the trends are length of the trends might be 6 or 7 or 8 weeks if you're lucky, where they used to be a couple of quarters. So right now, this is showing through our closing date of our last update. We update this once a week. This was how much of that 100% of money that was invested in all of the 11 sector spiders went to each sector. So energy was 17.9% of that sector pie, let's call it. Communication services are 3.7, financials 13.7, and so on. What this model does is shows where the biggest percentage of asset flows in took place over the past week, trading week, tactically, which is 1 month, and strategic, which is 1 quarter. So we're trying to identify the best asset flows and the worst asset flows, so we know the sectors to go into and the sectors to avoid. So through last week, the best ones were energy, and we do this on a point system. We add up. So energy was number 1 in percentage of assets in over the past week and over the past month. So that was 2. And then over the past quarter, it was 10. It was one of the worst. So it's showing you that energy has gone from a period longer term over the past quarter where it was one of the places where the money was coming out the fastest to switching trend where there's money going in there now on a trading and a tactical basis. It's number 1. So what we do is we add these up, and these scoring system shows us the best overall score. So right now, energy, communication services, financials, and materials are our best, and our worst are consumer discretionary and utilities. So those are the ones to avoid. Let's look at this in a chart format, and it's a little bit easier to understand. So the way our legend works is favored sectors are from 3 to 15 points. The lower the point score, the more positive asset flows going into the sector. So we have energy, communication services, financials, and materials here that are all in that favored 3 to 15. We highlighted the actual CEIF model signals, which there's more criteria, there's more hoops in order to be a CEIF signal. We highlighted those in kind of a lime green here. So you can see energy and financials are the current CEIF signals, but more broadly, these 4 are in that favored category of 3 to 15 in terms of scoring. And then you have your neutral category from 16 to 24, healthcare, industrials, real estate, consumer staples, technology. And then you have the ones to avoid, which are on that back part from 25 to 33 points. So we're avoiding utilities right now, and we're looking at these 4 as opportunities. Why? Simply that's where the money is going. Why do we do this? Because the performance has been extraordinary. This is the past 10 quarters CEIF model quarterly performance versus the S&P. It's outperformed the S&P in 8 of those past 10 quarters. In 2022, it outperformed the S&P by 12%, and since Q3 of 2020, which was 10 quarters back, it's outperformed the S&P by 36.4%. That's the first part of it. But we're actually more interested in risk. We want to be in models that are going to let us be relative performers or outperformers with the same or less risk than the S&P. So let's look at this risk profile. Over the past 10 quarters, the beta on the CEIF model is 0.91 versus 1%. It's a little less than the S&P. Our maximum drawdown, 22.5% during that period versus 25.4% for the S&P. Look at our annualized total return, almost double the S&P. Our total return, it is double the S&P throughout that 10 quarter period. So that's the power of CEIF. This is what it looks like on the chart. This is those past 10 quarters daily, S&P 500 in blue and CEIF in green. So you can see the minor wiggles are the same because we're investing in sectors that are subsets of the S&P 500. But here's a really good example of how CEIF works. Last year, 2022, the CEIF model went overweight energy as one of 2 CEIF signals during that period. It went overweight energy on January the 10th. It stayed overweight until June the 24th. So while the S&P was getting hammered here in the first half of the year, The CEF model stayed equal. It even went up a little bit. Why? Even though the other choice of the CEF model, there's typically two choices, or two signals. Even though that other one was going down along with the S&P 500, XLE had an extraordinary period there. From January to June, it outperformed the S&P by 40%. So this is the gist of why this works. We're following the money. We're doing it with about the same risk profile as the S&P 500, but it's going to the places where the money is going within the S&P 500 and avoiding those where the money is coming out. So there you have it. If you'd like to contact us and find out a little bit more about our services and pricing, you can feel free to contact us right here. You can call us at 888-960-0005. You could visit the Asbury Research website, go to the contact tab, and ask for information there. And you could also subscribe to these videos by going to our YouTube channel. Thanks for listening, and we'll see you in about a month with our next version of this video.